With me here, I've got Deborah Fuhr, Managing Partner and Co-Founder of ETFGI, Axel Lomholt, Head of ETFs International at Vanguard, and also Slawomir Rzeszotko, Head of Institutional Sales and Trading at Jane Street. Apologies if I butchered your surname there, Slawomir. I have experience every day of people doing that with my name, so I feel your pain. Is it okay if I call you Slav?
It's very good.
Okay. All right, great to have you all with me here, and thank you so much for joining. And we do also have a poll during this panel, which I'll bring up at some point, so get ready with your phones to answer that. But let's just kick this off, because basically this panel is simply entitled The Shape of the ETF Industry. So there's many directions we can take this in, but let's just start it off with the idea of a sort of a growing industry, one that's had exponential growth that we've talked about. Axel, if you unpack the data beneath the growth of ETFs globally, what is it telling you at the moment?
So I'm worried about unpacking data in front of Debbie, but the data that we have, it's interesting, because if you start at the global level, again, correct me if I'm wrong here, Debbie, but there's about 94 trillion invested in equities, and only 4 trillion is in ETFs, approximately. There's about 96 trillion invested in bonds, and less than 1 trillion in fixed income ETFs. So at the global level, there's still a lot of room to grow for ETFs. Now, if you unpack that a little bit and sort of look at each of the regions, it's interesting, because in the US, we've seen a transformational shift into ETF, and there's a significant market share gone from active into passive ETFs, and as Sean talked about, index. In Europe, we've seen similar trends, and there's been a meaningful shift. If you look outside of the US and Europe, it's a completely different story. And certainly in a story that we're really interested in, what will drive that. Because if you look at adoption levels outside of the US and Europe, we sort of talk about 1% to 2% of total investable assets in all of these regions. So a lot of what we're working on is what will drive that growth, that will sort of get adoption levels up. And if you think about it, even small adoption, increase in adoption from 1% to 2% to 4%, 5%, significant assets will go into ETFs.
And Axel's brought up a really important question, which is what's going to drive that growth? What is, in your view, Debbie?
Well, what we're seeing is significant growth in the types of users, number of users, and the way ETFs are being used. So historically, many times investors would say, I'll never use ETFs because I use futures. And now we're seeing that in many cases, as the cost of ETFs come down, if people don't want leverage, they're using ETFs. And clearly, given the ever-changing political and economic news, the ability to use ETFs to adjust to tactical changes that are happening rather than going and changing our external mandates is another important thing. But I think one of the most important is that over half investors hold their ETFs for more than 2 years. So it's not kind of an hour or daily thing. And governments are embracing ETFs. So if you look at Japan, the Bank of Japan owns 70% of all the assets sitting in Japanese ETFs, and have asked for ESG type ETFs to be created for that purpose. India's used ETFs as a way to dispose of some of the securities they own, and are looking at fixed income. And I think MiFID II has caused financial advisors and retail across Europe to start to embrace ETFs. So I think regulations can be both helpful and sometimes a bit of a challenge. So be careful what you wish for. But I think there's a lot of drivers for growth, but I think at the heart of it, the reason is ETFs are a really good tool for all types of investors. They're the only democratic product. And that's the reason I've continued to talk about them for a long time.
Your first thoughts then, Slawomir, on what's going to drive the growth of ETFs globally?
Well, it's difficult to not agree with everything that has been said. And I think Axel makes a great point about the fact that globally the picture isn't balanced, and we see different levels of adoption in different places. So there's clearly opportunity there. I think it's also quite interesting, the number that Axel mentioned in terms of fixed income, and how little of fixed income assets is still sitting in ETFs. And that's seemingly both a trend and a big opportunity, partly because of the actual innovation that ETFs are bringing into fixed income. And that's because it's an OTC asset class where using ETFs for exposure that gives you greater price discovery, gives you transparency, ability to mark your positions on an intraday basis, which are things that are not necessarily that easy if you're just a traditional bond investor. And actually what we're seeing as well is that ETFs are not only being used by fixed income portfolio managers or fixed income investors as an investment tool per se, but also just as a market data point or, as I said, price discovery tool.
Yeah, and I'm glad you brought up that point on fixed income. Let's just develop that a little bit, because I know when we had a conversation before coming on stage, you were saying that ETFs are kind of changing the way that investors are thinking and the workflow in areas away from ETFs as well.
Mm-hmm. Absolutely. So I think if you think about asset classes that are typically more challenging when it comes to fixed income, such as high yield bonds, for example, the emergence of ETFs in that space has been quite revolutionary from the perspective of actually delivering that price discovery, and a lot of investors are actively using fixed income ETFs just as a price discovery tool in that space. So it's bringing a lot of benefits, and on that basis, I think it has a space to grow. At the same time, obviously, it's democratizing the space a lot, and given the fact that some of those exposures are very specialized, it creates challenges in terms of education and the way how that change is being presented, because obviously you're giving investors, who not all of them would be equally sophisticated, access to some very specialized asset classes through an ETF. So there might be perception that there's always going to be greater liquidity at their disposal when trading fixed income ETFs, for instance. And whilst this might be true in times of when markets are calm, things could change in times of volatility. So there's clearly, I think, opportunity, but the opportunity begets education needs as well.
And in terms of the opportunity, Axel, I believe you think there are sort of three key pillars to drive ETF growth outside the US and Europe: market infrastructure, distribution, and regulatory tailwinds. Now, how do you see those developing in tandem? Will one of them happen more quickly or differently than the other?
It's a good question, and it sort of comes back to when we look at those three markets, we compare the US with Europe and the rest of the world. I think what the US have done over the past decade, or more than that, is just creating an incredible fertile ecosystem for ETFs. It's just one large homogeneous market. They created a distribution system which is largely non-captive. The regulators have been very supportive of ETFs growing in the US. And when you sort of lay that out over a spectrum, you haven't seen the same ecosystem develop in Europe and in other countries. I mean, Europe is certainly getting there, as Sean talked about. It's absolutely getting there. But in some of the countries, we still see really captive distribution that's hard to break down. Regulators are not really that supportive of ETFs. And when it comes to sort of the ecosystem, there's still a lot of work to do, as Slav talked about.
Debbie?
Yeah, I would agree. I think MiFID II clearly has opened up the playing field. But what you find is if you go to many mutual fund platforms here in the UK, often they don't have ETFs because they say there's no demand. But I think the real challenge is they don't have connectivity naturally to exchanges, because you don't need that for mutual funds. And so getting people to make the changes are challenges. And then some of the platforms don't classify ETFs as trackers. So someone goes away and says, show me the best FTSE 100 tracker, and you don't see any ETFs. And they're over in the bucket like a share, and you need to know exactly what you're looking for to find them. So I think we still need that level playing field to develop. It's improving. So I think we're seeing positive changes, but there's still work to be done. And that's why many of us have done ETFs for quite some time and kind of thought the education would be over a long time ago. Yeah. But as new products come to market and things change and new people look at ETFs, it's funny because people you could talk to will say, yeah, I know what EFTs are. And you're like, okay. So I think it's until someone does that first trade, they really don't understand them. But what I find is when someone does it the first time, then they tend to use them more in larger sizes and hold them for longer time horizon. Mm-hmm. So that first kind of getting over the hurdle of using them is really the hump that you need to get people over.
Yeah, and in terms of hurdles as well, I've had this conversation about ETFs for a few years now, and consolidated tape in Europe comes up a lot. So I always think, oh, do I need to bring that up again? But actually, it's still an issue, isn't it, Slawomir? Absolutely.
I think the ability to have an overview of post-trade data is still a big challenge. I think what has changed with MiFID II is that the data is technically available. However, aggregating and working with this data set has become arguably even more difficult. And that's something that is still a problem that's waiting to be addressed with some sort of a consolidated tape construct.
Axel?
Yeah, I totally agree. I hope we move in that direction.
Yeah, I think we're all agreed on that. We've had a conversation about it as well, Debbie. Now, in terms of sort of the idea of a handful of big players on one end and more niche players on the other side of the market, there's a sort of dichotomy that some have said has developed. What implications does this actually have for investors, both institutional and retail, Debbie?
Yeah, so I think if you look globally today, there's 412 issuers of ETFs, but the top three, which would be Vanguard, iShares, and State Street, account for 67% of all the assets. And currently, assets globally are at 5.7 trillion. So what you find is many people will put the larger firms on their select list, and then it is a struggle, I think, for smaller firms who are kind of niche providers to get onto those lists. Because if you don't have that full toolbox, people want to be able to use ETFs in different ways, and so they want firms that are going to have plain vanilla as well as some of the more innovative things. And so we are seeing select lists coming down. I think the US is more challenging because you take those exact same firms and they account for 82% of all the assets. So what you've seen is as new firms come in, they don't want to compete in the market cap space because there's a real pressure on fees. What they're trying to do is come in with smart beta or thematics or other types of things. But we do find that the plain vanilla plain vanilla market cap is where the majority of assets sit. And I do believe that many will continue to use that as building blocks going forward.
Mm-hmm. Axel, in an environment, we talk about growth. Growth usually equals competition. What should ETF providers do to best position themselves in a competitive market?
Well, I'll come back to something that Sean raised in his opening address. There's a lot of product out there. I don't even have a last count. And as Sean talked about, there's a huge range of asset class that investors they can choose from. And then blend that, he also talked about some of the regulatory challenges. And we spend a lot of time with regulators at Vanguard. And it is a bit of a concern. And we need to probably spend more time on working with clients and advise and counsel them and educate them how to actually use ETFs. I'm not entirely sure that some of the products we see in the market are suitable for sort of long-term investing, but that would be my guidance.
Right, but at the same time, the industry presumably wants to see innovation, and Sean referred to that as well, and how to manage that and sort of not almost attract too much regulation with the wrong kind of innovation. Anything to add to that, Axel?
No, I think innovation is good, and we can talk about some major themes. I think one of the big themes is how do you use factors instead of high-cost active. I think that in its own right is a great innovation. There's a lot of work there around sort of ETFs can replicate factors. We think that's a great innovation. There's a lot around sort of target date investing. How can you use ETFs for that? There's a lot of thematic, SRI, ESG, alternatives, and then Slav and David talked about fixed income. So in its own right, there is a lot going on when it comes to innovation. But at the same time, we need to be careful about how do we use that innovation in creating portfolios that sort of create better investment outcomes.
Yeah, and on the innovation topic, I mean, a big misconception, as I know you all know about ETFs, is that they're just a passive investment vehicle. And Debbie, I was a bit of a stalker. I have been following you on Twitter and looking at the things you put out there. And you put out a really interesting piece, actually, by Bloomberg, and I'm not trying to, push Bloomberg, but it was Goldman that sort of had done some work and said that active fund managers faced with dwindling liquidity and frequent blow-ups in individual stocks, look at the current market conditions, should use ETFs. Some ETFs trade in almost lockstep with their equity holdings while at the same time having much more liquidity. Now, they were talking about US listed products. So I suppose my question to you, Debbie, is will we anytime soon see that sort of innovation in Europe given the regulatory setup at the moment?
So, the reality is ETFs in Europe are as liquid as the US when you really think about it, because the true liquidity of ETFs is how liquid the underlying is. So if someone wants to invest in large size, and large is when the trades are typically over 20% of the average daily volume over a 20-day period. So I think there's a misunderstanding about liquidity, but I think the bigger challenge is that for many, it's really hard to find active funds that consistently deliver alpha. And I think that's the bigger challenge. And so if you unpack some of the active funds, you find that they're actually using a factor to generate alpha, either intentionally or unintentionally. And so for many investors, they find that using different ETFs, you can generate alpha through asset allocation. And so I think that that's probably the more important story is, what are you actually getting when you buy an active fund, and is it easy? So if you think about the US market, S&P does a study every 6 months, and they found most recently in the past year, large cap active funds in the US where their benchmark was the S&P 500, 69% did not in the past year beat the S&P 500, right? So you can spend a lot of time trying to find products that do, and on a 3-year basis, 79% did not. So I think that really pushes people to say there's a lot of value in indexing. And I think also being patient, you know, Sean mentioned being patient. I think for many investors, building a portfolio and thinking about long-term allocation, like Axel was saying. So I think the advent of robos is actually more important than we give them credit for. Because I think it's awkward for people who are married, your family, to talk about how much money you make and how you invest or don't invest. So robos allow you anonymously to go there and play. And I think not everyone goes to a robo because at the end of the day, you want to speak to someone too, right? Once you figure out how to ask the question. So I think that, you know, Vanguard's model in the US of this hybrid, you can play, become educated, but you can also pick up the phone and talk when you want to, is the way I think many robos are moving forward. So, yeah.
Slawomir?
So I think the point about visible liquidity and ability to invest in some of those maybe innovative ETFs is one that is quite interesting. I think it seems that the industry, as you say, there's going to be some dichotomy, or there is some dichotomy in terms of, on the one side, ETFs really becoming very much a business of scale, where to be successful, you need to be Vanguard, you need to be BlackRock, you need to be one of those huge providers with enormous infrastructure and ability to drive costs down quite a lot. But there's also quite a lot of niche providers who try the ideas in the thematic space. And we see quite a lot of those products being launched. And obviously, the starting sizes and seed capital and to get those products off the ground is not always very easy. But it's interesting and important to keep in mind that as long as the product is constructed correctly, meaning as long as there's unimpeded connection between the underlying liquidity and the liquidity of the ETF, and the creations and redemptions can happen freely, it will really be the liquidity of the underlying asset class that's going to be the limiting factor of how much you can trade in that ETF. Earlier this year, we had an example of an ETF that was 5 million in assets, and we facilitated a 400 million trade into that ETF, which would seem like it's very difficult from the perspective of how much was in AUM. But it was actually fine because the underlying asset class was very liquid. It was just UK gilts. So it wasn't making too much impact. So I think, again, it highlights the need for education, but I think also an important point that sort of was alluded during what Debbie and Axel said was there's maybe a little bit of misconception which is driven by the lack of harmonized terminology around ETFs. You know, there's a lot of labels that are flying around, and with innovation, it's likely to be increasing as well. What is an ETF? What is an ETP? What is an ETC? This is an active structure. This is physically replicating, synthetically replicating. I think if you overlay this with regional differences, you end up in a position where often you have two people talking to each other about ETFs and using terms that they think mean the same thing, but actually for their respective business or region means something different. And that's potentially a sign of a growing business, which still hasn't reached its maturity yet. But I think it's something important that will need to be addressed over time.
Right, and a sign of a highly diverse, not one-size-fits-all industry, right, Axel?
Yeah, I mean, really interesting discussion. I mean, when we sort of talk about the growth of ETFs, I think one of the big growth drivers, and I think one of that I personally underestimated over the past couple of years, is the adoption of ETFs within active portfolio construction. I think active fund managers actually find, as Debbie said, that this is a much cheaper way for me to get access to some of these exposures and about lower the cost of my portfolio. I'll tell you what, there is a really, really interesting piece of research that our friends in the US did, where they sort of wanted to debunk the whole myth about, all ETFs are index. And they look at the asset-rated return of the entire population of index funds in the US and index ETFs in the US. So if you do that math, it should all sum up to the US market return. And what the research shows is that it doesn't, right? And what they sort of proved our point was that actually there is a shift from ETFs being used by active fund managers. So we think that's incredibly interesting.
Yeah, and the other thing that's interesting, and we don't have a lot of time left, but it's come up a couple of times, is the cost aspect. So as well as being passive, what a lot of particularly retail investors associate with ETFs is their low cost. Now I know that again is diversity and divergence on this front. Is that always going to be an important aspect of ETFs, Axel, as the market grows, as it becomes more diverse, as you have more innovative products out there?
Well, if you talk about low cost, I can go on for a couple of hours, but we don't have this as 5 minutes. Hey, listen, I think as Sean mentioned in his opening address, the bottom line is that wherever you are investing in a portfolio of stocks, a portfolio of bonds, or you're investing in a mutual fund, you've got to do your own analysis. You've got to do your due diligence. And ETFs are not exempt. You've got to do your analysis. And low cost, as Sean said, is absolutely a big part of it. But there are other parts of an ETF, as Slav knows much better than I do. It's the total cost of ownership. When you enter the ETF, when you hold the ETF, when you exit the ETF. So it's that entire due diligence you've got to do.
I'll get both your thoughts on this, actually. Debbie first.
Yeah, I guess, you have to be careful because cost is not the only thing. So I think the first thing is to look at the benchmark. But then you might say, gee, there's an ETF in the US that provides exposure to whatever. And the cost of that one versus Europe is a basis point less. But you have to then look at what happens if you buy an ETF or mutual fund in the US. Well, they have to pay out income at least once a year, and you're going to suffer 30% withholding. Whereas in Europe, UCITS allow you to reinvest, or when income is paid out, you don't suffer that withholding. And where things are domiciled can cause different underlying. So I think it's really important to understand the domicile, the product, and is the product fully replicating or is it optimized, right? So there's different ways of structuring products. There's a lot of stuff you can dig into. And so that's why I do think when you go to use ETFs for the first time, it's important to talk to people who can help you think about how to make that decision and also help you to think about what is the best way to trade. Because one of the big challenges we saw after MiFID II is rather than trades going on exchange, about 70% of the trades now go to RFQ platforms, right? So it's important to understand how do you get best execution. And so to talk to people, I mean, you have experts sitting next to me who you can talk to figure out how best to think about what is the right product for you based on where you're domiciled or your underlying clients, and then how do you trade it?
Yeah. You're inviting an onslaught of everyone coming up to you after this panel. I love it, Debbie. So have your thoughts on the cost
of these guys. Yeah. No, they can come to me too.
I think, obviously, the same way as Axel can go about low cost, I can go about efficient trading for hours.
Yeah.
But it's interesting how there's been an evolution, I think, in terms of how people think about cost of ETFs. I think a few years ago, maybe it was the headline management fee number that was really capturing most attention. And I think as the users get more experienced, they start paying attention more to other factors. And some of them, Debbie mentioned around the index and the performance and everything else, but also the trading, right? So we do a survey of institutional clients globally every year. And last year, 55% of the responses said that cost of trading is the most important thing that they pay attention to when they're actually selecting an ETF among products that are available on the same exposure. So it's already quite a strong voice saying that there's recognition that this is an important part of the cost process. But in general, even more importantly, I think it highlights then that when investors are using ETFs, cost considerations are very much at the top of the agenda.
I just want to wrap up the panel. We really don't have much time left, but just with a quick thought from each of you on the future of the industry. We put up the assets in terms of trillions, and I've now realized I've forgotten to do the poll, so I'll do that at the end. But just very briefly, what's the industry going to look like in 10 years? Slawomir, we'll work back.
So I think we're going to have definitely more growth, and even the responses were showing that. I think it's going to be interesting to see if some of the trends that are emerging, such as ESG and SRI, will actually get adoption globally, and it will change the trajectory of this growth in any meaningful way.
Debbie?
Yeah, I would say it's important to remember ETF, it's just a wrapper. It's a fund with added benefits, right? So I think that I'm in the camp of the higher 25 trillion in 2025. So I think that we're still in the early days, although next year ETFs globally will turn 30 years old because the first product was launched in Canada, not the US. But we are seeing a lot more people use them. And I think that if you look around the room, there's probably some of you even here today who haven't used ETFs. And so the opportunity, again, is to get that first trade done. And I would say also, if you're looking to trade, I know that Chirag's here, the capital markets people who work at the firms are good at finding, is there someone who's currently sitting on inventory that wants to sell, as opposed to going out there and having to create or do something else. So there's a lot of resources within firms that you can tap into.
Yeah, final thought, Axel, on what the industry will look like.
I mean, very clearly, I can't predict the future, but my hope is that nowadays, outside of the US, is probably 80% institutional. I'm hoping that 10 years from now, it's more balanced. And we'll see much higher adoption by advisors and retail investors in ETFs.
Okay, great. You've all been huge pros. Thank you so much. And we finished right on time, which is perfect. But I don't want to shortchange you all with the poll. And actually, it feeds very nicely into what we've just been talking about, which is what factor will drive the most asset growth in ETFs in the next 5 years. So I put out there 10 years. 5 years is a little easier. Innovative strategies focused on cost or regulation. So just feel free to get on your phones and vote. And as I say, it's live, so we could see the shift, but innovative strategies, cost, okay. So two things we talk quite a lot about, and that's what the poll's saying. Focused on cost is going to drive the most asset growth in the next 5 years.